Let's go. Friday Eve on tap, folks. Good morning, one and all. Welcome to the Street Today here from Post 35 on the floor of the NYSE. I know. It looks like a green screen. It's not. Today is Thursday, March 16th. I'm JD Durkin. We're about an hour or so into the trading session. Stocks are what? Where are they? The Dow's down. The S&P is down fractionally as well as fears over, well, not really. I don't want to say fears over a potential banking crisis continue to loom large, but obviously there have been concerns with the banking sector. Started here, went overseas, kind of coming back in yesterday's session with a huge sell-off, and we'll continue to see what investors have in store. On the show this morning, we'll bring you the latest on that sector as the SVB fallout continues. Plus, we'll discuss how this crisis may impact the Fed's next move. It's a big week, next one. Plus, we'll dig into the labor market as jobless claims remain historically low. And finally, we'll tell you why TikTok may, and I underscore the word may, soon be banned in the U.S. I feel like we're still a long way away from that, but there is at least kind of movement in that direction, at least on government devices. There are updates. We'll bring them to you later on the show. For more on those stories and so much more, we now bring in our special guest on this Friday Eve, Octavio Marenzi, CEO and co-founder of Opimas. Octavio, good morning.
Good morning. Good to be with you.
It is great to have you and great to have your perspective, especially during a week like this on a day like today. Is the worst of this banking crisis behind us, or do people watching this from the outside wonder if there still may be a bit of risk? How do you see that risk assessment?
I think there's still substantial risk in the banking sector. So if you look at what's happened to First Republic today, it doesn't look like it's getting any better. So the market seems to be betting at least some of these regional banks are still going to be at risk. We've seen PacWest do pretty badly today as well. So those two banks are now sort of being targeted by the markets pulling down their stock prices. But you're right, it's sort of a transatlantic game of ping pong, basically. It started with SVB, jumped to Credit Suisse, now it's come back to the US. Who knows what's next? It could be anywhere.
You're right there. First Republic down 30%. I wonder, have there been other names? I think you mentioned PacWest. Any other names in the regional space you think are at least worth watching? I don't want to needlessly fan the flames of fear, but there have been a few key names, I think, in the regional space that maybe have a bit of exposure now getting a second look.
Well, definitely those two. I think a lot of the regionals might be kind of a risk because they tend to have more concentrated balance sheets than the larger players. So as a small regional bank, you just have access to fewer sources of funding than a big money center bank has. So people like Zion's Bank, even someone that large, might potentially be caught into this. So I haven't got any clearer insights further than that. It's kind of interesting if you go look at the financial statements of these banks, looking at SVB or looking at First Republic. The most recent set of financial statements for Q4 look kind of good. You wouldn't notice that these are institutions that are in big trouble or that there was enormous sort of problems on the horizon. Their financials look good. Particularly First Republic had a nice rate of return, was doing really well.
What do you need to see in terms of settling to avoid more of that ping pong? I want to be careful using the word contagion or needlessly getting people concerned, but I like the phrase of ping pong, right? That you and I talked about at the beginning of the conversation, back and forth. What settling do you need to see in the next day or two to give you confidence into next week that maybe at least the worst of this short-term concern is behind us?
Well, I think the fundamental problem that the banks are facing, both in Europe and in the US, is that we saw a very, very long period of ultra low interest rates, and suddenly interest rates have been jacked up. Now, the interest rate is a really important factor for the banking industry. It's what they borrow at, it's what they lend at. That is basically their business, is to mediate between long-term and short-term interest rates. Now, once you get into the mode of being sort of dependent on very, very low short-term interest rates and somewhat higher long-term interest rates, if that changes on you, your business model breaks. And there's no way around that. So basically, a lot of these banks plowed huge amounts of money into bonds, in the US certainly. In Europe, it's even worse. A lot of the large banks were forced to buy bonds with negative interest rates. For a while, for a couple of years, we had negative interest rates in the European bond market. That basically now is reversed. So interest rates have gone way up. And so they've lost enormous amounts of money that they haven't booked yet on those securities portfolios. There's no easy way around that. The only way around it is to basically lower the interest rates again and let the value of those bonds go back up. I don't think the ECB or the Fed can do that now, though. Ordinarily, that is what they would do going into this kind of banking crisis. They would look at it and say, let's slash interest rates, let's help out these banks by giving ultra loose liquidity and prop up that sector. This time, it's very different in the sense that their hands are tied. They're fighting inflation simultaneously. And to fight one, you have to risk the other. So there's really sort of the Scylla and Charybdis of the banking industry at the moment. They have to avoid one, they have to tempt the other.
Octavio, for people that have followed this story closely here stateside and are probably at this point of our news cycle familiar with what the U.S. government did on Sunday night in terms of the Treasury, the Fed, and the FDIC, could you help us better understand what some of those sort of backstops look like over in Europe as well? We talked a lot about what's happened here, but for people that are just kind of getting caught up onto either announcements or actions from the ECB this morning or other backstops, what protection do those banks have that we've kind of seen unfold here in the U.S. since Sunday?
Well, so far, the European Central Bank or other regional central banks have not had to step in the same way as the Fed had to, except for the Swiss National Bank in Switzerland. So in the Eurozone and in the pound zone, we haven't seen that kind of dislocation yet. So it's really at this stage limited to Credit Suisse and the Swiss National Bank basically, I would say, bail them out. I don't give them a lifeline. We're basically saying we're going to give you $50 billion worth of credit line in case you need it. So we can only really talk about that one single case. It's not like the Fed that basically sort of gave a blanket promise saying to all banks, we will lend against you, against your bond portfolios at the full par value. In Switzerland, it's basically the SNB and Credit Suisse. And they've been somewhat vague about what it really means and what the conditions and terms of it are. In the US, with the bank term facility, it's very clear. You're going to get this much money for these bonds and you're going to pay this interest rate. We don't really know what the SNB's agreement is with Credit Suisse. So I don't want to be evasive in your question, but they simply haven't told us and it's not clear. They've said 50 billion francs or $54 billion, but not much more than that in terms of details.
You and I were talking before we came on air, the ECB raising its own rates by 50 basis points in its own effort to go fight inflation. Do you think that gives the Fed here in the U.S. a bit more cover to do, maybe not the same to the extent of 50 basis points? Their mandate is a bit different than ours. But does the Fed here stateside, you think, take any cues from the ECB and at least move into a direction of more safely being able to raise 25 basis points next Wednesday?
Definitely. I think a 25 basis point increase is cooked in at this stage, basically, with the Federal Reserve. Who knows? Maybe they'll go to 50 basis points. But yeah, it certainly makes their life easier in terms of increasing that. What I've been really interested in by this morning, watching after the announcement by the ECB, because that's a pretty substantial increase in terms of rates, I would have expected the euro to strengthen a lot more than it did, and it's basically unchanged. So despite the fact that you can now get half a percentage point higher rates on euro holdings, it hasn't really impacted the exchange rates, which sort of implies that the markets are betting that the Fed is going to do something similar to the ECB, probably 25, maybe even 50 basis point rise. Otherwise, we'd see the exchange rates move much, much more than they did.
For people who are concerned, they're looking at this from the outside, still kind of wonder what this may mean to them. You know, let's say you had a family member call you up and say, Octavio, I don't know, I've got money spread in a big bank or a regional bank, and I don't know much about this sector. I don't know what's going on. Should I worry here in the United States? What would you tell that person?
I think as long as you have under $250,000 in each bank, you're okay. You're fine. So for those few people who keep over $250,000 in their checking account, they might think about spreading that money around more banks to be ultra safe and secure. And I would particularly look at the larger banks because, frankly, the Fed and the regulators are much, much less likely to allow the very large banks to fail and go under. But I think as long as you're okay with keeping under $250,000, then that's fine. I wouldn't think there's anything to worry about, really.
Okay, but now, first of all, isn't this now part of the problem of the idea of some of these bigger banks being too big to fail? I mean, it seems like this week we've had a rush of depositors withdrawing from some of these smaller banks, right? Let's say you did, this is just purely hypothetical. Please no one run off and do what I'm suggesting in my fictional story. You got your money in a First Republic or a Zions in Salt Lake City, and now you're saying, I don't know, JP Morgan Chase, that's the big guy on the block. I'm going to feel better going over there. Now you're making those bigger banks bigger than they ever were back at the time when we thought they were already too big to fail. Isn't there a risk in now having, which would be a move that I understand out of uncertainty, but couldn't that further exacerbate issues by kind of making even the big banks even bigger?
Definitely. But the question is, what do you do now with these failing smaller regional banks? So what happens with an SVB or what happens with the First Republic? Who's going to buy that? I know First Republic has said they're basically looking for a buyer right now. Well, it's not going to be a smaller bank that buys them. It's going to have to be a bigger one. And so that's going to lead to more concentration. I will say that the Biden administration has been very reluctant to approve any sort of bank mergers, even relatively small ones. So Fairly recently, the Bank of Montreal wanted to buy, I think it was First Horizon Bank, a relatively small institution that wouldn't have led to much more concentration. And there's many banks many times bigger than Bank of Montreal is in the US. They blocked that. A few months ago, they blocked the merger between Brown Brothers Harriman and State Street, which was sort of in a slightly different space in the custody world, but they blocked that as well, which was a big surprise because it didn't seem there was going to be that much more concentration as a result of it. So the Biden administration so far has been fairly strict on preventing bank mergers for fear of creating a too big to fail scenario. And here we are. We see banks failing, and the only way really around it is to let the larger banks take them over. I don't see an easy solution to that other than that.
To this point, what was your sense as to why SVB last week did not have any buyers? I don't know if that's particularly a question you've given a lot of thought on, but that's something that I'm still looking at the story from the outside. I'm not entirely clear what that answer is, as opposed to, years ago, a Washington Mutual or any other names that typically does have someone kind of come to the rescue. Regulators tried, as you know, but at least up until now, especially at the end of last week, no one was interested.
I don't know how hard they tried. Now bear in mind, back in 2008, when we saw firms like Washington Mutual and Wachovia being taken over by the larger banks, the Fed and regulators basically stepped in and said, we guarantee that you won't incur any losses as a result of taking on this loan portfolio. And you take on the deposits and the loans, and if there's a problem with it, we'll make you whole. I don't think the Fed provided those kinds of guarantees. Otherwise, somebody would have snapped it up in a second. First, you simply can't, I think, do your due diligence on a bank acquisition that quickly. It's going to take a few weeks or maybe a month or two to figure out what you're even buying. You need to comb through the books, look at the loan portfolio, understand the operations, the risk management, all those things before you go buy another bank. There was just a huge rush. And so unless the regulator says to you, listen, you take this over, we'll sell it to you for $1. And if there's any problems with it, we'll make sure you don't lose any money. That's what they would have had to do. And then they would have had lots of buyers. Bear in mind, SVB in the UK was sold to HSBC for a symbolic £1. So there was a buyer there. But there too, HSBC did not really know what they're buying. It's kind of a black box. They didn't have time to go through it and really understand what's inside. They just had to take the regulator's word for it, the Bank of England, to say, looks like a good investment. But they, I'm sure, had guarantees there in place to prevent them buying basically a bunch of junk loans, should there be something like that. I'm not suggesting that's what's in them, but I think they wanted to avoid having to have that kind of scenario.
So and again, I don't know to what, I'm sure you've dug into all of this, but one part that I'm really interested in is the Fed facility, because we will get new data today. I mean, you talk about the data points that the Fed will take into consideration for next week. Suddenly, one of them is the degree to which small banks may actively use this newly created Fed facility. The program is, of course, called the Bank Term Funding Program, part of that announcement on Sunday night. Octavio, is there anything there that you're following? I mean, I think this kind of will give us a sense to what degree other banks that may be in a similar-ish position to a Silicon Valley bank may need to use this new resource from the Fed. And we're going to kind of get that data in real time. I mean, the program is just a few days old to some degree, and we're already set to get it. And I wonder if that's something that you'll be following or some context we should know there.
Oh, definitely. We're watching that very, very closely, because that will give you a good sense of the sort of the health of these banks and how much funding that they need and how much liquidity they need. Bear in mind that there is a bit of a problem with this term facility in the sense that banks are going to be allowed to borrow against their securities, even if those securities have lost in value. They'll be able to borrow against them at the amount they paid for them, not the current market value. So there's going to be sort of a collateral shortfall there. So it's possible then in a year's time, the banks are not going to be able to repay those loans to the Fed, and the collateral they pledge is not going to cover that. So in a certain sense, we're sort of just delaying this. We're pushing it out into the future in the hopes that in the meantime, the banking sector recovers and the economy does well and the markets go back up, and this will all be forgotten. But there's a very real risk that we're just in a year's time face an even more severe problem in the banking sector, that these regional banks who've borrowed money from the Fed are not able to repay those loans.
Right, because these are in exchange for high quality collateral for loans. So you just said the point that I have not heard really anyone talk about. What happens a year from now? Or what needs to happen for a year from now to simply not kick this can down the road?
Well, I mean, let's run through a really simple example. So let's say you get $100 in deposits. The bank goes out and buys $100 worth of US Treasuries. those US Treasuries are now only worth 85. They've lost in value. The Fed allows you to borrow 100 against that 85 collateral,
100.
but they're going to charge you 5% interest. So a year down the road, you now owe 105 and your collateral is only worth 85. So you've got a shortfall of 20. How do you get around that? I don't know. The Fed is going to have to roll it over into some other facility, some other program, or allow you to sell off something. The problem doesn't go away as a result. I guess they're hoping the problem will resolve itself because people will calm down, and they've done a decent job of that. But I guess we've seen some of the contagion spread into First Republic now, and I fear that we'll see this go on. The question is then, 1 year down the road, let's say these banks are not able to repay the loan to the Fed. What happens to the equity holders of those banks? And I think there's a risk that they basically see their values go down quite severely as a result of that, where they have to take a really big haircut on the repayment of those loans, maybe even get wiped out. And I think that's what you're seeing the market do today with First Republic, despite the fact that First Republic has access to this lending facility or this term financing facility. They should be okay in terms of deposit withdrawals, but I guess the market is betting otherwise.
Before we go on to weekly jobless claims, this is, of course, the story of the last week, and you've already done such an awesome job, and I'm very grateful for your perspective and context. Anything else on this as a topic that you think is perhaps not being discussed enough, Octavio, or that you would want our viewers to really remember as they leave the broadcast today?
I think this question of contagion that keeps coming up, where there's sort of a sense it's like a virus that's jumping from one bank to the next, and if you just stop it in one place and build a firewall around it, it won't spread out. I think the problem is broader than that. The problem really is that we've had these very low interest rates for a long time that now have been increased. So it's like fish, we're all swimming in the same ocean, and we're all going to be affected at that in the banking industry, and there's no easy way around that. So there's no contagion. It's just that the interest rate environment has turned against the banks. And despite what they might have said just a few months ago, that higher interest rates were good, I think they're learning now they're not actually that favorable to them.
All right, thank you for that. With our remaining time, let's talk weekly jobless claims, falling last week to 192,000. What does that tell you about the state of the labor market right now, with it kind of coming in a bit lower, claims near historic lows?
Claims near historic lows, and so it seems the labor market is tighter than expected, and that means the Fed is going to feel some impetus to carry on increasing interest rates. We talked about the ECB raising 50 basis points. The Fed is probably going to do, I would say, probably half of that, but I don't think the Fed is going to back off the interest rate increases because they've basically staked a good deal of their reputation on fighting inflation now, so they can't be seen to turning around too quickly on that. So I think we're going to see the Fed carry on increasing interest rates as a result of that. And I fear that we're going to see the Fed fund rates go higher and higher. I don't see really an end in sight. I mean, the inflation numbers, the labor market, all those things point to very, very persistent inflation. And I think we might well see the Fed fund rates go above 5, 6, or 7% even by the end of this year. I think that's the direction they're going to have to go in to try and get that under control, which is going to risk the banking sector.
You might be the first person I've heard throw a 7 in there. I mean, we've been between this range of 5, 6, because I was going to ask your base case for where you think they go from here, but you're leaving that on the table. Are you in the camp of looking at the next 3 FOMC meetings and kind of projecting? You said earlier this we could have a 50 in March. But are you thinking like a 50, a 25, few 25s, or does it literally not matter? All that matters is where we end up.
Yeah, I think what really matters is the terminal rate. I can't get inside the head of Jay Powell and the other members of the Board of Governors at the Federal Reserve or the FOMC and figure out what they're thinking this particular week or month. It's sometimes really hard to say. So I think what they'll find is that inflation doesn't go away that quickly. Who knows if they do 25 basis points or 50 later on. But they'll find that inflation is kind of persistent and stubborn, much more stubborn than they thought. And that is not changing. So I think the interest rates have more possibility on the upside than on the downside at this stage.
Yeah, absolutely. We're not quite living in the era of January. The month of January to me feels like a solid year ago at this point, right? We came in, we had all these disinflationary data, talk of rate cuts in 2023. That to me is just, as soon as we hit February, that was firmly in the rearview mirror. It's amazing where we are now. Okay, a few more general investing questions, if I can here, Octavio, while you're being very generous with your time. Do you view this as a good buying opportunity? People will want to know where the dip is, where do I get in, when do I get in? What would you tell that eager investor who's trying to make heads or tails of everything we're looking at?
Look, I don't give individuals investment advice, and I can only talk for myself in terms of what I see the market and where I think it's going to go. I think now is a very good time to be sitting on cash or very short-term dated treasuries, like 6 months treasuries. You can get close to 5% for basically taking no risk and just sitting on the sidelines. So I think that looks like a really good place to be at the moment. Maybe if you're more adventurous, some precious metals or things like that. But I think these markets are only going to start to turn around when the central banks start to cut interest rates again. So that's basically the cue that I think we have to wait for. And in the meantime, while they're still jacking the rates up, there's really not that many good investment opportunities out there. So I would say sit in cash on the sidelines, or at least that's what we're doing, sit in cash on the sidelines and wait it out. Now, you might miss the initial rally by waiting a bit too long. But then again, you might miss an even bigger dip. So I think the smart thing to do is just wait, watch the central banks. Once they start to cut rates, they will tend to continue to do that for an extended period of time. And I think that's the time to jump back into the equities markets. And in the meantime, do nothing.
More than a few fans out there of the world of fixed income with rates as high as they are. A lot of visits to treasurydirect.com, I'd have to assume. Everyone loves a good Treasury Direct visit in a high interest rate environment. Finally, let's talk specific sectors if we can. Are there any of the 11 sectors you find more attractive than others right now?
Listen, I'm squarely focused on the financial services space. That's the sector that we cover. So it's not looking terribly friendly at the moment in that one sector. So we're very much in the banking space and financial services space. I would say perhaps within that world that we cover and look at, perhaps some of the investment banks, people like Morgan Stanley, Goldman Sachs, are going to be looking relatively better because with all this volatility and turmoil, their trading volumes are going to go way up. And I think they stand to gain a bit more than people, sort of the regional banks who are really suffering quite badly through this. So that's where I think within our sector, things are going to look a bit better. As for other sectors, we simply don't cover them.
Absolutely. I do want to, hold on, I am getting breaking news. I just want to make sure. Let me get this here. First Republic stock halted for volatility. Can I get your reaction expected for the day? I don't know. I don't think we can pull up the chart. But before we go on, I mean, you were talking about a stock that was down 23%. So one last quick note here before I let you go on maybe the health of either First Republic or any of these other regional names for the day.
Listen, I mean, like I said, if you look at First Republic's financials, the place looked really sound and good, but it's just an artifact of the banking model that no bank is totally immune to a run of the bank. So that's just what happens. They take deposits, they lend it out, and it means they have potentially a liquidity crunch if too many depositors show up and withdraw their funds. And I fear that's what's happened with SVB, that's what happened with Credit Suisse, and that seems to be happening with First Republic as well. So that's just part of the game of banking that one has to accept that these things are going to happen once in a while. It just seems that more and more of them are loading up. But in terms of First Republic being halted for trading now, I must say it's no surprise at all. That stock was under tremendous pressure, and I dare say when it resumes trading, I would expect to see it slip even further down.
Yeah, I'm looking over my shoulder here because I see it on one of the screens, trade halted, limit up, limit down. Of course, that's one of those things that we cover closely. So you know when it's put up here on the screens for some of the market makers, it's something that's worth tracking. I wish I had a camera shot of the screen that I'm looking at, but it's perched up there and it gives us a view whenever those trading halts happen. Octavio, this is a wonderful conversation. I hope you will consider coming back on the show because we all got smarter together. Octavio Marenzi is CEO and co-founder of Opimas. Octavio, thank you. Good luck weathering this storm, especially for your sector. Good luck.
Thank you so much.
That was awesome. Great conversation. Love that guest. All right, folks, coming up on the show, we bring you the latest headlines on a potential TikTok ban. We'll tell you why Virgin Orbit is in hot water. But first, I sat down with a few experts to discuss their tried and true investing tips. Take a look.
Put a plan in place and you stick with it because the moves are unpredictable. We do think the bull market will return. We just don't know when. Timing it can be a little difficult. Try not to get too cute. If you want to get into this market, we would do it gradually. I would gradually deploy to your own risk tolerance level, not throw it all in one day.
Charting matters. You know, having some kind of a understanding of the major moving averages that all institutional investors use. So it would be the 50 and the 200-day moving average, or the 50 and the 200-week moving average. Because if you look classically over the last couple of years, when we broke those, that's when we saw the big decline in 2022. And as we're clearing them is where we're seeing more buying. So I think it's good to have some kind of a navigation system, if you will.
I think the most important thing for individual investors right now, for the first time in nearly a decade, you have the ability to not just look at equities, but fixed income. You're actually getting a return. You haven't been paid in fixed income or that 40% of your 60-40 portfolio in a while. So pay attention to that. And there's some great opportunities out there.
I'm telling investors, make sure you're investing in things that you're fairly confident will continue to pay a yield and grow that yield, to have the business model and the cash flow generation ability to grow that yield over time. And some of the places we're seeing that right now, even though you'd argue that many energy companies long-term are value-destroying business models, I think energy is still in the sweet spot. I think cash flow for energy companies is going to continue to be very strong in the kind of economic environment we're predicting.
Thank you there once again to all of our experts for their tried and true investing tips. Let's now get you caught up on a few of the biggest stories that we are following for you at TheStreet.com on this Thursday morning. The pressure is on. For TikTok, that is, as the Biden administration demands the social media giant find a new owner. Like the second White House in a row. It's like, for the love of God, can you just find someone, please? The U.S. government asking TikTok's Chinese parent company ByteDance to sell the app or risk facing an outright ban for all users in the U.S. It comes as the administration continues to harden its stance on national security on concerns that the Chinese government could be harvesting user data. It's not the first time TikTok has faced a potential ban in the U.S. You may remember former President Donald Trump attempted to get the app banned back in 2020. Those attempts ended up being blocked by the U.S. courts. I think the scariest thing is, as we have this conversation, we just don't know what the data is actually that is being collected, nor with whom it's being shared. Is it location data? Is it contacts data? Is it the app seeing our messages? There's got to be some link. Because when I go home and I start watching a new show on Netflix or something, I open up TikTok, I get content about that show on the app. So it's tracking more than you think. We'll continue to follow the story. Next up, it looks as if Richard Branson's Virgin Orbit may be in some trouble. The embattled company announcing plans to furlough almost all of its staff and pause operations for a week as it scrambles to shore up its finances. According to several reports, furloughed employees were told they would receive an update by next week. This crisis comes after the company's failure to launch the first ever satellite mission from UK soil. That was in January. Shares of the company are tanking on the news, down over 30% on the session so far this morning. And finally, let's talk T-Mobile. That company announcing plans to buy Ryan Reynolds' budget cell phone provider Mint Mobile. You've seen the commercials, for $1.35 billion. T-Mobile said it will use its size and resources to, quote, supercharge Mint, which will continue to run for as little as $15 a month. Ryan Reynolds, who took a majority stake in the company back in 2019, will stay on in his creative role at the company, continuing to serve as a spokesperson. The deal is expected to close later this year. Welcome to Wrexham indeed. All right, folks, that's going to do it for The Street today. Thank you once again to our very special guest, Octavio Marenzi, CEO and founder of Opimas, for taking the time to join us on this Thursday morning. And to those of you watching at home, stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.